Look, it makes sense as you look at your portfolio and you're moving towards retirement. How soon do you start putting the triggers in place where you start moving whatever wealth you've accumulated into slightly, lesser riskier asset classes? But the problem is, if you look at the S&P over the last 10 years, we've had, the whole long-term debate has gone right out the window. It's very difficult today to sit and speak to clients about that, because they turn around and say, we've always understood long-term to work. You guys talk, everyone talks about long-term when you talk about financial planning. Let's have a look at the S&P over the last 10 years. Now, counter critics to that are going to say you can't pick up the S&P as a single measure because of the financials impact. But I think nonetheless, we don't believe that the fundamental premise in terms of building a portfolio for retirement changes. We believe in diversification. We believe in the long-term story. To the point that you're making, absolutely, I think it is a difficult time, and people have had to rework their outlook in terms of, if you were thinking you were going to be exiting in the next year or two, think again. Well, you've got to add a few more years, absolutely. Wealth accumulation isn't what it was because of what's happened.
Indeed. Okay, listen, Solomon, we're going to talk a lot more coming up in just a bit. Our guest host, Solomon Hyder there from Citibank in Singapore. Up next, real estate investment trusts may have taken a hit along with property markets, but are known, though, as safe haven place for property, even at the worst of times. So is it time to get back into REITs? We're going to talk about that coming up next.
It's filled with surprises, yet with a touch of the familiar. It's all those things you imagined, and some you didn't. It intrigues and fascinates, and often delights. It's a story of the world, and it's one with many endings. The 5-star global network. Fly to over 80 destinations on board one of the world's youngest fleets. Qatar Airways, world's 5-star airline.
The DIFC has laid the foundations for the organic growth of the financial services industry in the world's fastest growing emerging market. With a world-class regulatory and legal framework and a critical mass of leading global financial institutions, we have firmly established the building blocks for innovation in product, services, and technology, knowledge transfer and dissemination, business development, and sustainable growth. The result, increased availability of financial instruments, the development of regional local financial centers, and a dynamic skilled talent pool. The DIFC is the de facto international financial center in the region between the Eastern and Western financial markets.
Dubai International Financial Center, your gateway to growth.
Imagine a world of beauty, excellence, craftsmanship, and style. With unprecedented exclusive access to the key people, events, goods, and services that constantly redefine the world of fine living, the Luxury Channel offers you a unique opportunity to view, explore, and acquire the lifestyle you deserve.
On the next CNBC's Cash Flow, Hong Kong's recession-hit economy is likely to see further contraction when it reports Q1 GDP. But with tentative signs that China's economy is picking up, how can that help Hong Kong? We'll get a preview of the data and what it means for the markets.
It's time to get in the game.
Squawk Box, where business turns first. Tonight at 7, only on CNBC.
Yes, thank you. There we go. Thank you.
This is CNBC.com News Now.
All eyes are on Mizuho Financial after reports said the Japanese bank plans to raise about $8.4 billion by the end of September. Japan's machinery orders slid 1.3% in March, suggesting that a recovery in capital spending may be delayed. And the FT says Toyota is planning one of the most drastic management shakeups in its 70-year history next month when the grandson of the company's founder takes over the company's helm. You can find these stories online at CNBC.com.
Welcome back Friday morning here on Squawk Box. Real estate investment trust REITs have grown in popularity, but have also suffered along with the global property sector during the downturn, but they are considered, though, a low-risk security and have the advantage of paying dividends. So are REITs the place to put your money? All right, let's get to Peter Churchouse, Director of Property at Lim Advisors. He joins us live from Hong Kong. Staying with us here at our Asia headquarters is Solomon Hyder, Managing Director and Head of Wealth Management at Citibank Singapore, our guest host. To both of you, good morning. Peter, welcome back. It's been a while. So REITs taking a knock along with their bricks and mortar property. You think some of it is unfair?
I think, yes, it is, quite frankly. I think risks are much lower in real estate investment trusts than traditional real estate companies. Now, I was interested listening to Salman's remarks about pension planning. To me, real estate investment trusts fit very neatly into pension planning. They're partway along the risk spectrum, if you like, from very volatile equities to the more sober bond market. So I think they fit in very nicely. I could build a portfolio today in Asian real estate investment trusts that'll give you a dividend yield of between 10 and 12%, even now in today's property market. So I think that's a good thing.
Oh, 10 and 12% sounds pretty good to me, and I'm really curious. A, is this net, and two, talk us through names. Where, who?
Well, for example, in Hong Kong, most of the listed REITs are yielding you right now, even at today's prices, with the REITs having risen quite sharply in the last couple of months, are giving you yields of 11, 12, 13% in 2009. In Japan, where interest rates are much lower and yields are much lower, I can still find REITs that are yielding me between 9 and 11, 12%. In Singapore, 13, 12, 11, 14%, and in some cases as high as 20%. So they're out there, and they're still very cheap right now.
Salman, go ahead.
Well, I think I completely agree with Peter. I think it makes a lot of sense to have REIT exposure. Peter, just in terms of outlook, you know, we've got an economic environment where we're expecting to see deterioration in terms of the economy, and because of that, our analysts at least are looking at REITs suffering a little bit in terms of demand for office space and residential space. Asia, far more resilient, but any concerns there in terms of how you look at the rest of 2009 for REIT exposure?
Oh, absolutely. I think quite clearly the office markets in just about all of our major markets are trending downwards right now, both in terms of rents and in terms of asset values. The residential market's probably a little bit more stable, and you're seeing that reflected in the performance of the Japanese residential REITs in the last couple of months have actually picked up very, very nicely indeed. But absolutely correct. The discounts to net asset values that the REITs are trading at are about 40 to 50% right now, and that is building in an expectation that asset values in the property markets will come down. But I think they've probably over-reflected the downside risk in many cases.
Which seem to be. I think that's interesting because in light of how I wanted to pick on your intellect a little bit more in terms of, I saw a research note that just came out of Citi about the Shanghai test case for REITs, because they're setting up a REIT structure in Shanghai, looking at, I think, the Pudong area and seeing how they securitize that, and I think they're still trying to see whether it'll go a debt-like structure, an equity-like structure in terms of ownership of the underlying properties. A lot of benefits if Shanghai REITs work and how that develops for China. Any thoughts on that, Peter?
Oh, absolutely. I think REIT industries tend to develop out of distress in real estate markets. If you look at the Australian REIT industry, it grew very rapidly out of the distressed system real estate assets in the late 80s, early 90s. The same in the US, and I think in China you're going to see a lot of distress in real estate assets as well. So as these things come onto the books of the banks with people who can't repay debt and so on, securitizing these into portfolios of real estate trusts is it really does meet a need here. And secondly, I think it also feeds very well into the growing pension issues that we're seeing in China, the need to provide for pensions over the long term. So I think the REIT structure will work very, very well in China in the long term.
We'll be watching. Interesting stuff. Peter, great to talk to you, sir, as always, and very useful. Peter Churchouse, Director of Property at Lim Advisors up in Hong Kong, and we need to say thank you, also goodbye to our guest host, Salman Hyder, Managing Director, also Head of Wealth Management at Citibank in Singapore. Okay, we're counting down the start of Hong Kong trade now, 9.5 minutes away. We'll help you get set up for a trade for the Hang Seng this Friday when we come right back. Don't go away.